I wanted to make a quick video that I had intended on making and it slipped my mind over this weekend. I've been receiving some comments and some questions about these advanced transactions and how to fit them into your work. In the instruction document, I do say that these guys here, these two are adjusting entries, and that this one here is a closing entry, and that is true. However, I want to describe a few things around these entries that are of import that can sort of cement some of the things we've already talked about and help us, especially going forward into the income statement and so forth. So when you have these unrealized gains and losses in various securities, first, what does an unrealized loss or gain mean? Of course, well, that means that we've had a fluctuation in value for these underlying investments. So we've had a value fluctuation in the market, but the security is not sold. So I'm holding on to this share of stock or this debt, this bond of another company, and the value's changed, but I haven't yet sold it. So that's why it's an unrealized, because I haven't sold it, loss. Now, all of these security classifications, available for sale, trading, and held to maturity, all of them will have unrealized gains or losses because the market is continuously moving. Now, based on the classification, we are going to recognize them in different ways. For example, it notes down here, while unrealized gains on the trading securities impact net income and flow through retained earnings, the unrealized losses on available for sale bypass net income and are recorded as other comprehensive income. So we have a difference in treatment here. The impacts of trading securities, their unrealized gains and losses affect net income. If we think about how we've defined net income or the income statement in the video lecture, we have revenues, we have operating expenses, we have non-operating items, and then we have this all gives me my pre-tax income. These trading securities that are unrealized gains and losses go into non-operating items. So they are a part of our pre-tax income. They will affect tax expense. And as we calculate that tax expense and subtract it off, this is how they fit, or this is why, as that little blurb here says, they affect net income and they flow through retained earnings. Now, what I didn't really get into in Module 5, but becomes more important here, is that the unrealized holding loss on the available for sale, that one actually belongs in other comprehensive income items and impacts your comprehensive income. So these don't affect the tax expense that we're reporting on our current income statement. This will actually work itself into other comprehensive income. So we draw that line over here and affect comprehensive income. So it bypasses net income for the time. When we look at some of the other aspects of this problem, we have an unrealized loss available for sale security, security fair value adjustment available for sale. This unrealized security fair value adjustment is an adjunct account. It's an adjunct asset account. So when I'm recording this unrealized loss, it makes sense to credit it, because what we're doing is bringing the balance sheet value of my security down by that amount. So I'm crediting this account while I'm recording the loss, which means that when I report the security, this represents, as an adjunct asset, a reduction in value because it's a credit amount. I forget offhand, I can look it up real quick, what the value of that AFS was prior to. It was $25,000. So we have this AFS investment that has a debit balance of $25,000 and then a contra account of $2,000 with a credit balance. When I bring these together and sum them, because the adjunct account has a credit balance. I'm sorry, I said contra account. I meant an adjunct account with a credit balance. That credit balance then reduces this account to $23,000. On the other hand, when we look at this unrealized gain in trading securities, it has a debit effect on that adjunct account, and our trading security account would be increased by the $4,500 debit balance. Again, because it has now a debit balance, which is in line with an asset account's debit balance. And I'm going to look up that 1 and 2. That trading security was at $40,000. Because we have two debits now, that's going to align to sum up to give me a $44,500 value for the trading security on the balance sheet. So that's how we record these guys at fair value, is through the use of these adjunct accounts. Now, you don't have to worry too much more about that. I did want to describe what was going on here, as well as inform you that the trading securities do flow through net income, and that the tax effect isn't going to be felt on this accumulated other comprehensive income item until it enters later or is sold, and that's why we record this deferred tax asset here. When it comes to the discontinued segment, this is just showing you where the impairment came from. As we learned in video 5.2 part 3, we looked at impairment, and we said, well, impairment is a recognition that the book value of an asset, or in this case of a discontinued division or component, is greater than its fair value. And so this is the justification behind figuring out that we have to impair. And more precisely, or more to the point, what I want you to see is that when we're impairing a discontinued division, really what we're doing is looking at here are all the assets of that division. This is the restoration division. Like, Viezuchter was able to say, well, $16,000 of cash go to this. $2,000 of accounts receivable belong to that division. $6,750 of garage supplies. Well, what is it that has to be impaired? It was the equipment, and the impairment of the equipment came down to looking at, the equipment has a book value of $12,000 and it has a fair value of $5,000. And this is where our overall analysis of the net assets is picking up some necessary impairment for this division. Then we look at the impairment loss. Well, what's happening here is I'm fixing this asset. I'm recognizing that $7,000 of impairment loss, and it's showing that that impairment loss is going to the discontinued division, but it's specifically referencing a piece of equipment that that discontinued division is using. Let's look at what happens when we apply this to the equipment. The equipment had a book value or a historical cost of $15,000, and its accumulated depreciation at that time was $3,000. So what this journal entry is doing is it's resetting the accumulated depreciation to 0, and it's crediting the equipment account by $10,000, so that now we have a $5,000 book value asset that is equipment, and that $5,000 is equivalent to what I wanted, which was to impair the value of the equipment down to its fair value. So that's what this journal entry does. It just shows you more specifically what's going on when I have an impairment of a discontinued operation. I simplified it in a more broad way in the video in 5.2 by saying, well, generally we're impairing the whole division. But more specifically, we're going to find that you can apply impairment to individual assets, and they don't have to be assets of the discontinued division. It just so happens that this one is an asset of the discontinued division. Therefore, this impairment loss is going to be found in discontinued operations. Now, this whole entry is an adjusting entry. And this impairment loss affects net income. How do we know that? Because if you remember from that lecture, we have, just writing out, because it's always good, never can get enough practice, writing out the structure of an income statement until it just becomes old hat to you. Excuse my dog. You see someone jogging outside our house. And after we have tax expense taken out, if we have a discontinued operation, then we have income from continuing operations. And from that, we add or subtract any discontinued ops, which leads me to net income. This impairment loss feeds into something I would report in my discontinued operations. It is also going to be considered for tax expense, because while these things are net of tax, they still occur prior to net income. So we're going to use the $7,000 in my tax expense calculation, just like all the other adjusted revenues and expenses. The only item you will not use that is a revenue or an expense in your tax expense calculation is the unrealized loss from the available for sale securities, because again, it goes into OCI, which is after net income, and we recognize its tax effect through a different route. Okay, but all the other items, all the other losses and gains and losses should go into your tax expense, And I believe that that addresses most of the questions I've been seeing and deals with these sort of unfamiliar transactions. Right?